all those rents did when we got out of having publicly traded REITs was catch up to the rest of the world. And in theory, those rents were actually, theoretically, those rents were actually deflated relative to the rest of the rental market.
Whether you're developing a new student housing community or acquiring an existing one, fast and reliable internet isn't a luxury, it's a necessity. But when it comes to serving college students, standard telco providers often fall short on both performance and support. Don't risk a frustrating experience for you and your residents. Choose Campus Technologies, a provider with nearly 25 years of expertise in delivering top-tier internet infrastructure and exceptional customer service for student housing nationwide. Beyond high-speed wired and wireless internet, Campus Technologies also offers managed IT services to keep your property management team running smoothly at their properties. Even if you're not currently in the market for a provider, you need to know the best practices for upgrading your property's internet infrastructure. Download their latest white paper today. You can find the link in the show notes or visit campustechnologies.com.
All right, so this is working. Welcome to our session today, where we're going to be focusing more on the off-campus life side of things. We've had presentations from folks right from the student affairs side of things, but now we're lucky enough to have a panel of distinguished folks with a ton of experience from the off-campus side. We've got Wes Deese. He's going to be kind of spearheading this panel. He got our panelists together. A little background. I'll let Wes kind of introduce some things about him and what he does. He runs the Student Housing Insight. If you've ever gone on there to watch some of their podcasts and information, it's very useful. I've been on there a few times. We met during COVID when I was asked to be on a panel in my former role when I was at Georgia Southern. So Wes and I have known each other since, COVID. Hey, that's the fond memory. Not COVID, but so Wes is just fantastic on connecting folks across industries and across the country. So with that, we'll kick it off. Thank you, Wes.
Thank you. Well, as Peter mentioned, I'm Wesley Deese with Student Housing Insight. Student Housing Insight is really a place for off-campus student housing professionals to network and consume content relative to our industry and the things that are going on. We do, in addition to a podcast and several kind of meetups at live events, we also do a monthly webinar for the industry that actually came out of COVID when the universities went on spring break in 2020 and kind of told the students, hey, just don't come back. We as an off-campus industry began having to answer a lot of questions for investors and the like as to, okay, are we going to be able to collect rent? Are we, what is the fall semester going to look like? And the industry came together and really started this kind of weekly Zoom call, as we all, we're doing in our spheres. And one of those turned into a pretty large call where we were sharing some data across the industry, and we realized, hey, sharing this data actually rises all ships, and we need to continue doing that. And about 2 years after some of those folks who led that initiative were getting a little worn out of having that call, they reached out to me and said, hey, we want to provide some other content, but we're not really sure what to do. If you've got any ideas, let us know. And I said, are you really sure people want to continue having 2 years later, the student housing COVID response Zoom call? And so we did a survey. A lot of people said, yes, we do want to continue having this call. And we want to expand it down to the site level managers that are at the sites, because it felt like there was a lot of great information for them. So I said, great, I'm not going to call it the COVID student housing monthly call. Let's rebrand it something else. So it is called Shop Talk. I should have made a slide for it, but SHOP stands for Student Housing Operations. So you can go to shoptalk.info, and we do that typically monthly. We don't do it in August because everybody knows why. But the other 11 months out of the year, we do it. And yeah, a lot of great information that you'll find there on what's happening both from a pre-leasing and rental rate standpoint, as well as with National Multi-Housing Council, which is a lobbyist group based in DC that does a lot of stuff for the apartment industry. They provide policy and legislative updates that are really important and impact your students. So make sure you join in for that. I've got a great panel today. I've done this, I think Peter and Chris I think this is the third time they've had me back. I was not able to make it in Wisconsin last year because my wife fell and broke her wrist and happened to have surgery the same day. So it's glad to be back and glad to be with the bigger StarRes family as well. And the main thing that we want to do in this panel is really kind of give you a perspective of what things that we're seeing from as off-campus housing providers and P3 providers, and kind of give you some of the things that we're seeing, and yeah, just chat about them and make sure everybody's updated on it. So with that being said, I'm going to let the panel introduce themselves, and we'll start with Jason.
Hi, everyone. I'm Jason Taylor. I'm Managing Partner of Public-Private Partnerships at the Annex Group.
Hi, I'm KrisAnn Kizer. I am the Vice President of Leasing and Marketing for L3 Campus, who provides housing across the nation to students and works with universities as a master lease partner.
My name is Mark Miller. I'm Director of Operations for Inwood Management, which is the in-house property management company for Gilbane Development.
Well, great. And guys, thanks so much for taking the time out to come here. Obviously, July is not the easiest month for folks in the off-campus world to travel and make presentations, but appreciate you guys doing that. So how is off-campus purpose-built housing performing? For any of those that have joined us on Shop Talk, we've got a relationship with a company called College House, also known as House Analytics. And very much like College Pads, they kind of started out as a listing company. Then they realized they've got some really important data that developers and housing operators should be paying attention to. And so they created College House to share that data on a more favorable timeline. We've got other companies in the industry that do that, but the information was typically 60, 90, 120 days old before it was published. And so a big part of what they're doing is making sure that it's coming out weekly. And so the information that you'll see from their slides today comes from their June ended report, which was from all data through actually July 3rd, so just last Thursday. What you're seeing here is the map here is actually separated into 5 regions. Pretty much what we're seeing is everybody's within 2% plus or negative of where they were this time last year. Nationally, they're tracking same store, which is not every student housing property that's out there, purpose-built student housing property, but it is a wide majority of them. And that same store is tracking about 1.3% ahead year over year. That has been tracking, this will show you the past 5 years on a month-to-month basis. As you can see, that line that's down at the very bottom is lease up for the 2020 or through the 2020 leasing season for fall 21. As you can see, there's been if you're looking at it on an annual basis, you can see that these communities have started leasing up earlier and earlier over the past 5 years. We've seen a little bit of variation on that this past leasing season, and it's kind of caught up a little bit closer to, I would say, what we actually saw in 2019 as far as the velocity is concerned. But overall, still in a really good position as far as that's concerned. I wanted to talk a little bit about some of the markets that our panel has observed, and where you feel like off-campus demand is exceptionally higher or maybe lower this cycle than what seems to be the reasons behind it. So I don't know who wants to take that first, but
I definitely think one of the markets that I've seen a big slowdown, I don't know if anyone in here is in Bloomington, Indiana, but that market 2 years ago, I had a property that was full by Thanksgiving. Last year it was full by Valentine's Day. This year it is still leasing and probably not going to be full. And that just comes from a lot of development in the market. We're seeing that there are more and more beds coming online, and sometimes that's not meeting the enrollment at the same pace. So they're delivering before the enrollment catches up to what the projections are.
And I should have specified my primary role with Gilbane and Inwood is on the public-private partnership side. So I'm in operations in P3, and I would say at least, and I'm not about to tell you anything you don't already know. International students are a big deal for this coming fall. So that's what we're seeing from our side of the house as well, is that there's some big challenges there.
well, and you kind of stole my next question, which, this time last year we were kind of seeing the FAFSA fiasco created a lot of issues for everybody that's in this room, I imagine. For us, we really started noticing some type of impact in March to the leasing cycle of, traffic wasn't really down, but students just were not making decisions. And a lot of that certainly had to do with the fact universities, in some cases, were pushing out, their assignment dates until May and June. And, students and parents didn't want to make that decision of moving off campus until that was finalized. And also, the off-campus FAFSA doesn't necessarily impact us a lot on the because we're not leasing to freshmen and first-time students for the most part. So it was kind of weird seeing that impact, and it took March and April before we really started feeling it. But man, once we got to July, and we can go back to that, we were falling 2%, 3%, 4% behind come May of last year over year, and we couldn't really pinpoint what it was other than FAFSA. But we got into July, and it took off. This year, some of those kind of outside elements that are impacting things that operators are hearing does seem to be campuses where there's more than 15, 20, 30% of international enrollment. So just wanted to find out from you guys no one knows the number yet, but what are your site teams and folks telling you, what's the discussion on international students?
I know one thing that we're seeing is later decision making due to the closure of visa appointments for a short period of time. We had to put in place a visa waiver. So we were allowing them to sign leases, but if their visa did not come through, if they were not able to get the appointment, if it was canceled for any reason, we would cancel their lease agreement with no penalty.
I saw a lot of operators doing that.
And it definitely did help. We didn't see as many people take advantage of that as we were expecting, but we did have a good number. We've also seen a shift over the last few years of where those international students are coming, at least that are living in our off-campus properties, where the numbers in a lot of the markets I'm in, the students from India are finally outpacing China. And for off-campus providers, sometimes the funding of those students is different from different countries. And so if you built a property and aimed it at a specific group of residents and a specific price point, you might not be seeing the students who can meet that price point be the international students who are coming now. So that's definitely one thing we saw. And then we have students who have signed leases for next year who I guarantee are not going to show up because they did not get their visa, but maybe they didn't sign during the waiver, or they just haven't communicated with us because they're still hoping, or they may be showing up later as they're still trying to get those appointments, which I'm sure you guys are seeing on campus. You're seeing students who you're probably expecting 1%, 2% not to show up. Those numbers may likely be higher this year. And then as of July 4th, the new bill, we are also seeing people who were planning on getting Grad Plus loans who are not going to be getting those now, who are now saying they need to make other arrangements because their funding isn't going to be there.
I guess I would add, I'm thinking maybe from our current operations, we're seeing maybe about a 10% decrease in international students year over year.
Yeah, I mean, I would. That's about the number I would have given to. I think it's about 10% is what we're saying. We're certainly trying to, where we have properties that have more international students, we're trying to backfill a little more aggressively than we may have in the past, and make sure that we've got, more where it's legal and allowed, more contracts than spaces, knowing we're going to have maybe outsized melt. And then Wes, I'll just say on the development side of the house, and Brian and I were just talking about this, the uncertainty is like the enemy of everything, right? Mm-hmm. And so simply not knowing is enough in and of itself for us in some markets to say, gee, we're not going to build, or we're going to build a different product, or we're going to think differently about what we're doing, because gosh, we were thinking about studios 1s and 2s and pointing toward graduate students in a given market, but 30% of their graduate students are international students, and we don't know what that melt's going to look like. We don't know if it's ever going to come back, right? And so, I think it's a little bit of a question of like, I always, I say a lot, in the hallowed halls of the Annis Group, we can underwrite into a number, just give me the number.
Right.
When you don't write it, interest rates high, interest rates low, God, I hope they're lower, but interest rates high or low, we can underwrite into it. Enrollment high or low, international students X or Y, but if you're telling me you just don't know, that uncertainty is really challenging.
Are you seeing, and KrisAnn, I know you've got something to add there, but I want to stay on just from a P3 standpoint. Are you seeing universities that, because you're dealing with deals that are going to come out of the ground 2-3 years down the road, are you seeing any of this uncertainty, especially on any campuses that had a pretty large international enrollment? Are you seeing them speak up with any hesitancy about maybe we need to put this project off for another year? Or?
Yeah, I think most of what we're seeing is a lot of deciding that we're going to go for multiple phases, right? So we're doing a deal with Middle Tennessee State right now in Murfreesboro, Tennessee, and they were going to do 2 phases, 1,600 beds. Well, now it's 3 phases of 550 to 600 each, right? And so let's take them a little bit slower. They're fortunate. They've got a wait list. There's a lot of international students on that wait list. Let's take it a little bit slower, and let's build the first phase a little bit smaller than what we thought, and let's think about how we get more deliberate. Now, we could find ourselves a year from now going, wait list hasn't changed, nothing's changed. The first project 600 beds, and the second project is 1,000 beds, and that may be what happens. But the way they've thought about it, and the way a lot of campuses we're talking with have thought about it, is the demand still exists. Right. So the question is, how do you bite off that demand? And, maybe it's just smaller bites.
I was going to actually ask you kind of similar to that. Is it changing what you're building? Are you making things that are adaptable, that if they won't work for those undergraduate students, they can be transitioned into family or graduate housing? Yeah,
most definitely. So on the off-campus side, I do both our on and off development for both our on and off-campus student housing. On the off-campus side, we're definitely focusing on studios 1s and 2s, and how do we, some 3s, but we all know the roommate challenges of odd numbers. But we're really focusing on how can we have a differentiated product for a lot of reasons, right, that are not just international students, that get us out of the sort of 4-bedroom business for the most part, right? I think, off-campus purpose-built student housing is built on, 80% 4 bedrooms or 70% 4 bedrooms, and how do we drive that? And that was an innovation 20 years ago that really made a ton of sense and continues to make a ton of sense in a lot of markets. But I think we're seeing 2 things, which is one, just sort of, we could look at certain markets that, Madison, Wisconsin, for example, right? That is like, I saw the face you made.
We're in due diligence on a property there.
It's really challenging in 4-bedroom apartments. And we're sort of seeing I think maybe it's not generational, but sort of a way people operate shift. We have a property in Pullman, Washington, where it used to be that 2/3 of our 4 bedrooms, the person came with 3 other people, right? 4 people came and rented a 4-bedroom unit. It's the exact opposite now, right? It's usually 1 person coming, and now it's about 1/3 of the apartments, 4-bedroom apartments, that they're coming with, a whole group. And so, is that a reverberation of COVID? Is that just sort of who students are today? I don't know that I exactly know the answer, but I think it is driving what we build and what we think about building.
Yeah, I was just going to add, there was a news article that I read this morning about a HBCU in South Florida Memorial, yeah. It's about to do a big P3, but they are really, I mean, they're talking about residence halls, they're talking about workforce housing, they're talking about a very diversified kind of portfolio on campus, and I think that's also a good example of how things have kind of changed a little bit.
Yeah, we're doing a deal in San Bernardino with the San Bernardino Community College District, very similar. They bought 15 acres and said, how do we figure, and it happens to be on a fault line and all the California things, right? There's a hill and there's, all the things. There's indigenous remains, I believe is what we refer, artifacts, that's what we refer to it as. And the question on that side is, well, so what can you build, what can you do, and what can you do that, just like Florida Memorial, right, in that part of Miami, what can you do that satisfies a demand for your students and improves the quality of life for your students, and also drives what you can do for the community? And so in that instance, very similar to Florida Memorial, we're doing workforce, that waterfalls, sort of essential worker. If you work for the county, if you work for the city, if you work for the community college, if you work for the Cal State San Bernardino, et cetera, and then also capital A, affordable housing with low-income housing tax credits. And I think we're seeing a lot of institutions that are pointed that way. We're doing a project with University of Oregon that's it's 50 townhouses, right? And it's for students with families and faculty and staff. And the bug there, what you got to hit is it's got to be 80% of area median income so that it's actually affordable to their students and faculty and staff. I think we're seeing a lot of that right now.
So I want to switch over to the conversation about rental rates, and a couple of data spots for you here from College House. From a year-over-year basis, the Southeast is seeing the biggest increase, but nationally we're looking at about a 4.6% year-over-year increase in rents. That's looking at when a developer is underwriting a project, they're typically looking at 3, maybe 4% rent increases over the first 5-10 years of a project each year. And this past year I should say 4 years specifically, they've been swimming in a lot of rent increases, as the entire nation has. I'll look at it from a 5-year line graph standpoint. That bottom line is where we were in June of 2020, and then that top one is where we are currently sitting. These are for rates that if a student was to walk into a leasing office today, these are the rates that they're looking at for move in for this fall. So you can kind of see it started at $989 per bed and is now up to $1,008. The difference between 2021 at $798 a bed to today is 21%. And I looked at that from a standpoint of what's happened nationally. And so looked at some data from a group that provides that not only for student housing, but across the market for multifamily. And it was after I took out student housing, senior housing, and military housing, it was 29.9% increase over that same time period from June of 2021 to today. So a couple of markets, even though I kind of see nationally everybody's getting back down to normal ranges, there are several markets I wanted to highlight here that we're seeing still some pretty dramatic increases, but we're also seeing some pushback as far as year-over-year leasing. And it's not, and these specifically, I can't point to, well, there's more inventory that's coming on as well. On that one at the top, that is Oxford, Mississippi. So you've got a 35% year-over-year increase in average bedroom rates, and they're currently 2.9% behind year-over-year, but still they're already pre-leased at a 96.5% pre-lease occupancy. Columbia, Missouri, about a 7% increase year-over-year, a little bit of a pushback, just under 2%. Blacksburg, Virginia, total of 7% ahead and almost a 5% decline in pre-lease occupancy. And then the last one there is Auburn, Alabama, at a 15% year-over-year rent increase and just over 2.5% pushback. I've talked to a lot of operators specifically in these markets. They're not pushing back on rents because my question to them is, hey, have you got to catch up for next year, or are you going to end up dropping rates? And most of them seem to be, reaching out with some other type of, I would call them marketing expenses, and not taking it off the revenue side, where they're giving out gift cards and similar things to incentivize the students to lease and purpose build, not go out to, in most of these markets. I mean, there's not a ton of what we kind of consider the shadow market or the conventional market that they can go to. But KrisAnn, I wanted to go to you and just see if there may be someone in our audience who may be in one of these markets and they're seeing something similar to this, or they may be in one of these markets. And just if you could kind of help connect the dots on things like giving out gift cards and things like that, how that may end up setting the stage for next year, because I think as they have conversations with students about moving off campus, they may want to enlighten them a little bit as to what happened this year that's going to probably impact the leasing cycle next year.
I think I have some good news for all of you who were really annoyed with how early we were pushing students to lease. I know some of you have those partners who they move in and a week later, they're like, renew your lease, sign a lease right now. Here's the bad news. That's still going to happen. I guarantee you a lot of my colleagues are going to be asking people to sign leases in September, August. I know some markets, they've already started pre-leasing for fall 2026 now. But students are going to have options later because students are smart. And they said, my friend waited and signed in July and got a better rate and a gift card and free parking and this, so I'm going to wait a little bit longer. So in some of these markets where it is slowing down a little bit and there are a lot of incentives for students to sign at the very end of the year, they learn. And we're going to go back to 2016, 2017 when leasing was happening later and later. You're still going to see those early renewals. You're still going to see your off-campus partners wanting that fall housing fair. You're still going to see them trying to be on campus flyering your students. I apologize now. But it is going to give students a little bit of a longer time to make a decision because less and less properties are hitting 100% as early. So they are going to have time in the spring. Now there are some new developments, I'm sure some of you have these in your market, who are going to be full very early because there is always that 1, 2, 3, 4% of the students who money is not important to them. It's being at the it place, that brand new development, that gorgeous high rise that costs more than your mortgage payments. But there is going to be more opportunity for students to wait a little bit longer in a lot of these markets as the leasing season expands. It was great. We spent a couple of years with 5-6 month leasing seasons on our side. It's going to year round again in a lot of markets where you could sign a lease 2 days before move-in and still move in and have multiple options.
Well, I want to stick with this conversation around affordability, and this next slide that I've got up is actually from apartments.com. They did a recent survey that they released in May, basically surveying 1,100 college students and kind of what the top I think it was 9 or 10 type of factors that go into their decision making. And as you can see there, 86% of those that were surveyed said affordability. And I don't think that's a shocker to anybody, but I think it's, I remember a time when internet used to be the number one issue. So affordability has always been the top 3, but I think it is certainly taken over number 1 at this point. And outside of public-private partnerships, developers can't deliver, off-campus housing without, how's the best way for me to state this? They've got to react to the market, and I think that's a lot of what we've seen. But I think we've probably got a lot of folks that are in this room that are seeing some of the same, private equity funds that are investing in off-campus housing that are also working with Jason and Mark at Gilbane, and probably saying, well, if those guys are wanting 35% rent increases in Oxford, what in the heck am I supposed to do? Because it's really been on the university side to deliver that affordable to make sure that their on-campus housing options are affordable. So I wanted to kind of talk a little bit about, why does that make sense? Jason, you want to start us off?
Yeah, I think the easiest way to think about it is I think most, if not everyone in the room's got a retirement account, right? You've got an IRA or a 401k or something. And inherent in that is you've got a mix of, mutual funds and things that are investing in whatever it is that you've decided. Some of them are more aggressive and some of them are less aggressive and more stable, right? They might be things like bonds or, sort of more low risk investments. And the lower the risk of the investment, generally speaking, the lower the return that you expect. The higher the risk of the investment, the higher return that you might expect. So it's interesting, if you think about the capital market world, the biggest investors, if you can believe it, in assets like student housing are the Fidelities and the Lincolns and everyone whose name is familiar to you because it's probably literally your money and your 401k. And they are taking some of the very low risk, low return money and investing it in things like the housing that you might build on your campus with general obligation debt of the institution that has a very low interest rate, but you know that you're gonna get that money from the institution or the state or whomever is backing it at a relatively low interest rate, but you know that check's gonna be in the mailbox, right, every month. There's very little risk in investing in it. I see your shirt, University of Tennessee, right? Now, on the other hand, in the off-campus world, certainly, and in some context of the on-campus, of the P3, world, but certainly in the off-campus world, there is inherently more risk, right? We can't turn the dial of demand and supply on any given project in a similar way that you might on campus, where you might say, those rooms that were singles or doubles now because we're over, we're gonna fill this building first before we fill that building. We can't do that, right, in the markets where we operate off campus, and there's inherently more risk. Therefore, if you think about that profile of your own sort of 401k, the higher return threshold is where we view typically things like off-campus student housing. That's got a little bit more risk to it. It's not open, generally speaking, to the entire market. It's open to whoever happens to be a student. That's where we're leasing it to. And to KrisAnn's point, there are markets that lease slower or faster. To Wes's point from earlier, there's a little bit of uncertainty that's inherent in that. And so they're seeking higher returns. So inherent then in that is they're attempting to accelerate rental rates, attempting to increase rental rates relative to the return that you might expect. When we talked about this before, Wes, it was sort of like, you think about buckets of money and what they're going toward. Like we've all got a savings account, and then we've all probably got something that looks a little more aggressively at like stocks or equities or whatever. And literally that's how the capital markets world operates, right? And your on-campus housing, when they're investing in that, is sort of your typical savings account. You're always going to fill it. Even when you don't fill it, you're going to pay the bills and pay them for the bonds that they've bought to fund the asset. On the other hand, the more equity-driven way to think about it is our off-campus housing, which is subject to market volatility in a different way and therefore has more risk that's inherent in it. And then, Wes, I think the other thing that I'll just share is I don't think it's a surprise that the 2 years that we saw the biggest acceleration of off-campus purposeful student housing rental rates was the 2 years after we no longer had publicly traded REITs in student housing, right? I mean, between American Campus and EDR, there, I want to say almost 300,000 beds of student housing in this country. I don't think it's a surprise, when they reported as publicly traded companies, they talked more about occupancy than they did about rental rates or revenue increase. It was like, we're trying to get that 95 to 98%. And if we get there, everyone's going to get there, get that check in the mailbox that we talked about, right? Because the reason you invest in a publicly traded REIT is for that dividend check. Well, then it all became private equity, right? Which is not a bad thing. It's not a value judgment. It's just true. It all became private equity. And that shifted to, hey, to your point, Wes, off-campus rents, forget off-campus, market rents are up 29%, right? I tried to fact check you. I went to the St. Louis Fed and I said, Wes can't possibly be right. And I checked the St. Louis Fed. They would tell you it's 28% in the period that you said 29. So call it 28 and a half. The reality is if you think about off-campus student housing, all those rents did when we got out of having publicly traded REITs was catch up to the rest of the world. And in theory, those rents were actually, theoretically, those rents were actually deflated relative to the rest of the rental market world. Doesn't feel good to say, doesn't feel good to charge students high rents, doesn't feel good that we had, like an 8% increase a couple of years ago, right, annually. It doesn't feel good, but that's just the reality because suddenly you're talking about a different capital source.
And when you're looking at it from a national average too, just go back to that point, you've got, a lot of your more urban metropolitan markets where you've got purpose-built student housing, they haven't seen as much of an increase as what like Oxford, where they've gone up substantially more than what's what conventional or market rate is. So that's the other thing that's tough about looking at that from a national average standpoint. I do want to park something on marketing that I planned on asking the panel, but I think we'll have another chance to do that towards the end. I want to stick on public-private partnerships and talk a little bit about this slide that came out from Brailsford and Dunleavy back in November. And the key question that I've got here, Jason, what you see on this graph is so the bar graph is the number of deals that actually closed from a public-private partnership or a private-private partnership in each of those years going back to 2014. The other little dollar sign that you see implanted, in those same columns is the average deal size. So going back to 2014, we had 32 projects that closed for average value of $79 million. I want to ask you what happened in 2021 where we had 21 deliveries, but the average cost was $177 million.
Yeah, I mean, it's not going to be a surprise. You had a few really big deals that happened in 2021, and then you also in 21 had people who were getting very aggressive about the fact that interest rates were so low, right? I mean, we just talked about cost of capital, right? Like when interest rates are low, money is less expensive, and boy, any dollars that you're sitting on, you better get it out the door, right? And so I think in 2021 we just saw a lot of deals that got big or bigger even because there was never a time that interest rates were any lower than in 2021. You could borrow at the lowest. What's that?
Said should have bought my house then.
That's right, or refied anyway. Yeah. I mean, show of hands, who refied in 21? I certainly did, right? I mean, like that's, and so not surprisingly, a lot of deals went from call it the $80 to $100 million range to $200 or $300 million because you could, on the P3 side, because you could borrow so inexpensively, and it was sort of an acceleration. So it was the opposite of what I talked about earlier when you think about phasing. It was like, oh, let's do all these beds right now all at once because they're actually economically feasible.
Yeah. And 2023 is the last year that's on here, 14 deals, and it's back down to $94 million. How did 24, have any idea how 24 ended up?
Yeah, I'm going to say 24 is probably going to be relatively similar, Wes. I'm going to guess that, in fact, that probably dollar per deal probably turned down a little bit too. I think we're seeing a lot of opportunities. I think we're seeing a lot of them that, and Mark, I'm certainly interested in what you've been seeing, but a lot of opportunities, a lot of them that are relatively smaller, a lot of them like, the great thing, what you all did at Eastern Michigan, that are lots of phases of not just one new building, but renovation of existing buildings, for example, which is inherently less expensive. And then I think we're also seeing, as we talked about earlier, that focus on lowercase a affordability, so not using like tax credits or anything, but that focus on affordability and of thinking about how can you build, differently. This partnership we have with the University of Oregon, for example, I think they're great townhomes, but let's all be honest, it's not, if the University of Oregon was building it, it's not exactly what they would build themselves, right? They'd probably, use concrete, we're using wood. We're probably using sinks that are, of a 80% standard to their 100%. You could sort of go down the line. I mean, we could talk about wiring, for example, right? They would use a different type of wiring than we're using, but it literally saves $100,000. I think we're seeing a lot of institutions that are making that decision that they don't need to build student housing in the same way that they build classroom academic buildings that they're going to last for 200 years or the life of the institution.
Yeah. I wanted to hit on really quick some things to kind of remember for our audience when they're dealing with off-campus providers on maybe not a P3 type of thing, but maybe something a little bit more short term, and one being master leases. I've helped negotiate for both the university side as well as the private operator side on master leases. And there's a lot of things that I've seen that I've kind of have to feel like I'm kind of repeating the same thing year after year when it's a new university. One of the main things being, well, why do I have to pay you for 12 months, or why does the contract have to be 12 months when I've only got students there for 10 months? And of course, the biggest issue with that is the private deal that's financed by both lenders and investors who want to see payments and dividends on a monthly schedule. And what are we going to do with an empty building for 2 months collecting no rent? So it's either going to have to be 12 months compressed of revenue pressed into 10 months, or we spread it out over 12 months. But I wanted to ask you guys, anything else with master leases that you would say, hey, make sure, we've ran into this in the past, make sure you're building this into the structure or understand this during the negotiation process?
So I've done quite a few master leases. We've done partial building, whole building, multi-year. We've had it where we only kept one of our staff members on site, and the university, which was Savannah College of Art and Design for that one, brought in their whole staff. They ran the office, they ran maintenance. We just had one person there to keep eyes on things because obviously it's still our building, and if it burns down, we have responsibility there. And the biggest thing I would say is set expectations and don't assume anything. The assumption that the security system is going to work a certain way, the door system is going to work a certain way, that work orders can be put in a certain way, that's going to vary by the different providers you're using. So you may have done a master lease one year with Jason, and you go to do one with Mark the next year, and what their expectations are completely different. So no assumptions can ever be made. Walking through the property and making sure it works for your students and for you. We were on the verge of a master lease. They walked the property. We had 3 units with balconies that overlooked a main street, and they actually canceled the master lease because they did not want any balconies, and they needed a certain number of beds. So be aware that just because it has worked one way for you with one provider does not mean it will work the same way with the next. We were willing with my previous company to allow someone to bring in their own security and do their own security. But with another investment partner that I was consulting for, they were not. They wanted to keep their security in place because of the way their loan was written and what they were able to do. So it's not always us saying, no, we can't do that to be combative. It may be something in our loan agreement, in our funding, in our partnership with our investment partners, things like that, that makes us have to say no to a certain request you're giving.
Well, and I would add along those same lines that just make sure when you're operating, you're eye to eye on operations too, because they might not want, just like a 12-month versus a 10-month contract. Somebody graduates, they don't want to let them out of their lease. Someone leaves school for a personal reason that is perfectly legitimate to the college or university, that the master lease is going to say, no, they have to pay for it. So just make sure that you're on the same page with those things as well.
The other thing I wanted to chat on is listing services, and college pads included in that. As universities are contemplating, using something like college pads or a competitor, or doing something in-house besides just a PDF list of off-campus housing properties that are on the website. Obviously, that can be a revenue generator for both the university and whoever the partner is with that. But I've seen a lot of things that have been constructed at times of the year that I think made sense to the housing department, but didn't make sense to the rest of the market. One of which I think it was a market that College Pads was actually contracted with the university, and we got a phone call, I think in January, of, hey, you want to list for spring semester for the next year, list your properties. And it was a scattered site portfolio, and 3 of the 4 properties were already completely leased up for the next fall, and the other one was 86%. So adding additional expenses didn't make sense, and we also didn't want to take anything away from anybody else by having our properties even listed on it. that's one thing I would just, if you're going through that decision process, just make sure you understand the timing with the off-campus cycle and specifically budgets, because those things are typically, if a property is, if they've got a fiscal budget that reflects the academic year, those budgets were pretty much baked at the end of May for the next academic cycle. And then if they're on a calendar year, there's a little bit more give on that. But just wanted to, I didn't know if you guys had any other takeaways on listing services or anything else, just for folks to be mindful of.
I guess that's me again, being the off-campus person and the marketing person, but just realize that it doesn't ever need to be combative. Like, I think one thing that helps is having an annual or a semester meeting that puts you on the same page. So I know that's a lot to ask, and you guys are very, very busy, but instead of having every single housing provider in your market come into your office, if you have an annual, a quarterly, a semester, once a semester meeting, you can get the same information out much more clearly. And I'm a firm believer that meeting in person helps things, because tone does not always come across in text, in email, or on the phone, but in person you can build those relationships, and you never know, it goes both ways, when you're going to need to reach out and have that support from off-campus housing. And there's a lot of things we can do for you that you don't even know about. We have a lot of money in some cases, very helpful for your programming.
In some cases.
In some cases.
I was going to leave it open for Q&A. Yeah, if you got time.
You need a mic, I'll give you a mic, but you're loud.
We'll make Jason answer all the questions.
Hello everyone, John Armstrong from UConn. Great information today. Thanks so much, Wes, for everything. My question was back on the slide you had showed about the cost of rental rates. The rental market I'm in Storrs, Mansfield, some of the prices we see rival what are in Boston. It's incredible. And the cost per student, that's the one, Wes, we're seeing $1,500 and higher for rates. More and more properties are moving towards a rent by the bed, and we're talking about affordability that's very hard for students. Could you talk a little bit about why we're seeing more of that increase in rent by the bed as opposed to a joint and several lease?
I was to say, on the side I come from, we've done rent by the bed at every property I've been a part of. Sometimes we'll have a conventional rate. If we're roommate matching, it allows them to have the security that if a roommate does not pay, their responsibility ends there. So that's really where rent by the bed comes from. One thing we also have to educate the students, many cases on our side, we're providing different utilities that would not be provided in a conventional joint and several lease. So we're providing internet, trash, water, sewer, things like that. So it's explaining the cost and breaking them out. But yes, in a lot of markets, those prices are going up. I mean, when I was in college, when dinosaurs roamed the earth, my rent was $500 a month for my apartment. That same apartment today is going for $800 and something. I looked it up the other day, so it's a little scary to see just in those years how much rents have increased.
But if you were really a dinosaur, I don't know that you would be complaining about $300 over that amount of
I
time.
know.
But no, the other thing, yes, on the utilities, but I do think our conventional counterparts, there's a lot of ancillary revenue that they, not just internet and TV, but valley trash services and all of that don't show up in those national numbers in a lot of cases.
Just a quick question. How can we better educate our students to be prepared for the changes in terms of what they can expect for when they're looking for an off-campus apartment, in terms of money and funding and things that they need to be prepared for?
One of the coolest things I've seen, and I know several universities do this, I saw it first at Arizona State, if there's anyone from Arizona State in here, is they would do a move up, move out program with their outgoing freshmen, and they explained how lease terms work, what to look for, what's included, how to budget, how to understand and look for scams, because unfortunately that's a big part of what they're seeing. But I think having something in place where students can go and learn, or having a guide on your website. Ohio State has a great guide on theirs for off-campus student housing that I've been looking at recently because we work with them. But providing that information, and you can partner with our off-campus providers. Just let them know if you're going to do it that they probably can't talk about their own properties and they need to make it more generic, but having them come in and lead those sessions can be great.
At the same time you're planning your off-campus housing fairs, I think is a perfect time to have some type of session. I'm sure I'll volunteer college pads that's something they should put on their services, because I think there's plenty of the folks that they're working with in the off-campus side that would be more than happy to walk through the lease. Or biggest thing I've always told students my entire career, anytime I've been involved in that leasing process, is roommates are the most important thing with this experience. So regardless of what you like on this tour and everything else, that you gotta keep that number one, because that's gonna, that's really gonna tell what your experience at the property is gonna be like.
Well, and I think from a practical common sense standpoint, just something like a comparison piece where they're not thinking about the fact that they're going to have to pay for internet, they're going to have to pay their electric bill, maybe a gas bill, they're going to have to pay for trash maybe, or all those different things where when they're living on campus, it's one price.
Food.
I'm just curious, are there any campuses that you know have a great relationship with the private properties that are out in the community? Are there any kind of markets that you work with that you feel the campus is really tied in very well, and there's a strong partnership between the private sector and then what on-campus housing is offering?
There used to be this guy, Georgia Southern, I think his name was Pete.
Oh my.
I did get to work with Pete there. I would say it's been years, so I don't know if it's still the same. Arizona State was a great one for me. Ohio State's off campus, and Commuter Student Services has a great program with a lot of, whenever there's liaisons between the two, I feel like it works really well. So if you buy into the program, you're helping fund it, and there's a liaison that you can come to for your specific property and for any issues, that generally helps. UGA was a good one for me. And I know any of the markets where we got to work with college pads was great, because we could go through them and it took a little bit off the university, who may not always have the resources. Some of you guys, your departments, your one-man or one-woman shows, and that makes it really tough. So having them as a additional staff member really can help too.
I was going to ask one quick question as it was coming to mind, and I know we're going to go to lunch. The moves for what was going on in the P3 kind of worlds of places, and I know we've got on-campus and the off-campus community here, but have you noticed, or has there been a stalling in conversations about come in, take over the debt, or come in and manage the facilities, as opposed to a P3 development? Yeah. Has that slowed down? Is that speeding up in some cases? Is it I'm just wondering, because right now certain things have happened in the state of Georgia.
Yep. Yep.
Hey, another plug, selfless plug for crazy things going on in states. But I wonder across, with debt and all that sort of stuff.
I was just going to say, from an operations perspective, schools are realizing they have a choice. I mean, we really like to come in and do the operations, and that is specifically maintenance and custodial and capital projects, never the front, student facing like Res Life, et cetera. But schools are realizing they have a choice, and it's more incumbent on us to prove our value in most situations now than before it was, well, that's just kind of part of the package.
The only thing I would add, Pete, is yes, and I would say everyone just needs to focus on what they do well, right? And I think we all have to be honest with ourselves about what we do well or what we don't do well. And on almost every campus, residence life is done pretty well or really great. That student-facing, right? Like it just makes sense. Unfortunately, a lot of campus, the facility maintenance is not done well, and often for reasons that are beyond our control, right? One of the key elements of a P3, whether it be an operating P3 or for existing or for new, is we literally every year have to fund a capital reserve and we can't touch it, right? And I worked in on-campus world before I did this. That wasn't exactly true. Right, and we were making decisions about what we were or weren't going to repair and replace, as opposed to, we've got a bucket of money that says we have to use it to repair and replace. And I think, at the end of the day, for a lot of campuses, it's that discipline that doesn't always exist for reasons that are often beyond your control that causes them to partner with Inwood and partner with Annex and others to figure that piece of it out. But I will tell you, the residence life piece, 95 times out of 100, 98 times out of 100 is much better kept with the institution and is much better served to be with the institution.
Thank you very much.
Thank you.
So, yeah.